What's going on? Alex here, and today I'm answering your tax questions from Reddit. And today's question has to do with the tax implications of being paid in cryptocurrency, which then goes down to zero. Let's take a look. All right, so this question comes from Micro Needling Alone and goes as follows. I did a job in exchange for $10,000 in an esoteric cryptocurrency. At the time it was received, it was trading for $10,000, and that's what it was worth. A little less than 2 hours later, before I even had the chance to sell because I wasn't at home at the computer, it was effectively worth $0 due to the volatility of crypto and hasn't recovered and realistically never will. So now I've already been punched in the face once by doing $10,000 worth of work and ending up with nothing to show for it. But I'm okay with that because I understood that risk when I accepted the offer. What I'm not okay with is the prospect that I also owe taxes on a quote-unquote income of $10,000 because that was the fair market value at the time it was received. Is this really correct? Not only did I do $10,000 worth of work for free, but I have to pay the IRS a few $1,000s for doing it? I really hope this isn't the case. I'm thinking there's an argument to be made that the original quote-unquote fair market value of the coins wasn't truly $10,000 due to low liquidity, but I really don't know. Even then, I'm not sure how I would go about exactly establishing the fair market value. There are a few things to keep in mind in this situation, and there are really two aspects to it when you look at it from an income tax perspective. The first is that this person was paid $10,000 in cryptocurrency. All right, so that was the agreed upon fair market value that they received in exchange for the work that they did. That's the first aspect of the transaction. The second aspect of this is that the cryptocurrency that was received then goes down to zero. So let's take a look at the first part of the transaction, the payment of $10,000. Now, that's what was agreed on when the work was done. So you said, I want $10,000 for this work. You did the work. You received $10,000 worth of value at that time. From an income tax perspective, there was $10,000 of, in this case, most likely self-employment income if this individual was filing Schedule C and they didn't have an entity in place, such as a S corporation, a corporation, things of that nature. So it would just end up as self-employment income on Schedule C. From there, the question then becomes, how can we approach the fact that the investment in the cryptocurrency went down to zero? At that point, it's effectively the same as having received $10,000 of cash and then using that $10,000 to invest in crypto, which then went down to zero. Okay. And at that point, it's potentially a loss when you sell the cryptocurrency. In this case, it's not clear if it was sold yet or not. It sounds like it wasn't. The treatment then is, once you get rid of that cryptocurrency, once you have a transaction that you basically get it off your hands and you receive zero for it, then you're locking in the loss. You're realizing the loss from an income tax perspective, and then it's treated as a capital loss. It is going to allow you to then deduct up to $3,000 of that loss every year against non-investment income, so things such as wages, things of that nature, until this loss is exhausted. It's going to be $3,000 a year until that loss is used up. It's not as great as getting all of the tax just written off in the year in which this occurred, but at least there's some tax benefit there. The caveat being that you need to realize the loss, right? So you actually need to go onto the exchange or wherever you have this cryptocurrency and hit that sell button, all right? And get a confirmation of some sort that you had this much crypto, that you sold for this much, and that, from an income tax perspective, allows you to establish the loss. Once that's established, then we can get it on the tax return and start deducting that $3,000 against non-investment income. All right. And also, if you happen to have capital gains in a future year, you can offset more than that $3,000 potentially. So let's say you sold the crypto in 2022, you realized the $10,000 capital loss, and then you had $10,000 in capital gains. You can then offset the two and end up with zero capital gains for the year. So it's not a total loss from an income tax perspective. But the way this is going to play out is once the $10,000 is received in fair market value for work that was done, for a service that was performed, that is very difficult to change after the fact, because the flip side of 10,000 going to zero is that 10,000 in crypto going to 100,000 or a million, right? You wouldn't want to make the case that, hey, you know, I agreed on 10,000, but I should really be taxed on 100,000 or a million because the crypto increased in value shortly after the time at which I received it, right? You're not going to make that argument. So the tax code is not going to let you say, oh, well, I received 10,000, but it immediately went to zero, so it's as if I received zero. It's not really the case. It's two separate and distinct transactions, if you want to think of it that way, and you have to approach it in that manner. So there's going to be self-employment income of $10,000. You can offset ordinary necessary business expenses against that, but in the year in which that was received, that's pretty much very likely to be the case. Then you have to deal with the loss going from 10,000 to zero. You essentially have to realize that loss, meaning hit that sell button. That would then allow you to treat that as a capital loss and deduct $3,000 year over year. Now, the question that comes to my mind as a tax professional, right? We always try to be creative, try to come up with ways of looking at things from an income tax perspective that may be beneficial to our clients within the rules, of course. But in this case, the question that comes to my mind is, what was the manner in which the $10,000 value went to zero? All right? Because it says here that the crypto was volatile, but in some of these crypto situations, because the market was essentially the Wild West, there were many instances where it was basically a rug pull, right? So you invest in a certain cryptocurrency and it was clear very shortly after the fact that it was established solely for the purpose of defrauding individuals out of their money. And from there, the cryptocurrency ceased to exist. So in that case, I would want to take a look at the situation from the perspective of a theft loss. All right, and I may go into that in a little bit more detail in a later video, but you always want to think of creative ways to approach these sorts of things, especially when you have these extreme swings in value from 10,000 to zero. The question of fraud and or theft loss comes into play and may produce a bit more of a beneficial income tax treatment to the situation. So that is one potential way to look at it. But from here, given the way the situation plays out, unfortunately, there is going to be income tax liability in the year in which the income was received. The question is how and when the crypto was disposed of, and that will determine the second chapter of this situation and how that's going to play out. But very likely to end up with $3,000 in capital losses written off on an annual basis moving forward until that loss is exhausted. So if this video was helpful for you, feel free to hit that like button, subscribe to the channel, leave a comment down below. I love reading your comments. And we will be back soon for another video. Hopefully this was helpful. Thanks for watching.